Hi guys, welcome to my channel once again. If you are a returning subscriber, thank you. If you are just seeing this channel for the first time, please like and subscribe to the video and share it. Today we're going to be looking at IFRS 9 compound financial instrument. As you already would have known, financial instrument is any contract that results in the financial asset of one company and the financial liability and an equity instrument of another company. And when we are looking at financial instrument, as you already would have known, we have their key components with financial asset, financial liabilities, and equity instrument. However, there are sometimes where one financial instrument has two characteristics. So compound financial instrument are financial instrument that have the characteristics of equity and liability at the same time. So in this video, I'm going to show you how to separate a compound financial instrument to the respective equity and the liability component. The leading and the main example of compound financial instrument is convertible bond. So each time you see convertible bond given to you as an instrument, there is a likelihood that that will be tested as a compound financial instrument. So how do we separate compound financial instrument into the equity and the liability component? So here is an illustration. Global Bank issues 2,000 convertible bonds at the start of 2012. The bonds have a 3-year term and are issued at par with the face value of 1,000 per bond, giving a total proceed of 2 million. It's not every exam or question where they'll give you the total proceed. So otherwise, if you've been told that bonds are 2,000 and the face value is 1,000 per bond, you multiply the par value by the number of bonds issued, and that gives the total or the gross proceed. Interest is payable annually in arrears at a nominal interest rate of 6%. Each bond is convertible at any time up to maturity into 250 ordinary shares. When the bonds are issued, the prevailing market interest rate for similar debt instrument without conversion option is 9%. If all this is sounding like deja vu, don't worry, we are going to demystify it in a short while. 3-year 9% discount factor are simple 0.772, cumulative 2.531. If you are familiar with accounting, these figures are taken, or this year are taken from the present value table. So if you check 9% for at year 3, because the term of the bond is 3 years, you're going to see 0.772. But if you go to cumulative discount factor table and check 9% year 3, you're going to see 2.531. 9% year 3 for simple discount factor gives us 0.772, and 9% year 3 for cumulative discount factor table gives us 2.531. Required. What is the value of the liability and equity component in the bond? This is the requirement. We have a hack, simple way of determining how to separate this. So I've listed the following step, which you should treat very important. The first thing to do when you are dealing with compound financial instrument is, number one, you calculate the gross proceed from the bond. Number two, you ask yourself, how long is the term of the convertible bond, which the term or the tenure of the bond? Number three, you identify the nominal interest rate and the effective interest rate. The next step is you compute what is the interest payable annually. You compute the interest payable annually using the nominal interest rate. Don't forget here that you need to identify the nominal and the effective interest rate. But the next step is, when you want to calculate how much interest will be paid annually on this bond, you calculate that annual interest payable using the nominal interest rate. The next step is you find the present value of the annual interest payable using the cumulative effective interest rate, and you find the present value of the gross proceed using the simple effective interest rate. That EIR stands for effective interest rate. The next step is add the present values, that's the PVs, of the interest payable and that of the gross proceed to get the liability component. Then you subtract the liability component from the gross proceed to get the equity component. So based on the steps listed above, step number one, what we said is that simply you determine the gross proceed from the bond. At this point, you might want to take a snapshot of the question just to help you read through, determine the gross proceeds of the bond, and let's see what happens here. We have 20,000 convertible bond at 1,000 per par value. That gives us 2 million. Then second step, we say determine the term or the tenure of the bond, and the bonds are issued for 3 years. The next step was to find out what is the nominal interest on the bond. This is the interest that the company issuing the bond, Global Bank in this case, for instance, will be paying to the bondholders. And number 3, determine the effective interest rate. We use the effective interest rate for amortization. In the subsequent videos following this, we're going to explain more what the effective interest rate is. But how do you know what is an effective interest rate in a compound financial instrument? Some examiners will tell you plainly that this is the effective interest rate. Some examiners will call this effective interest rate internal rate of returns. And in some examples, like the one we have here, it said similar instruments without conversion option are 9%. That is still telling you about the effective interest rate. And the next step you were told that I listed out for you is to find the annual interest payable. The annual interest payable will be calculated using the nominal interest rate and not the effective interest rate. So the annual interest, 6% multiplied by 2 million, it means that you will be paying 120,000 per year for this 2 million bond. Then the next steps that I listed will help you to get to the final answer, what you were required to do. And in this case, once you are able to identify these ones that are here, the next step is for you now to determine the liability and the equity component of this bond. So following this next step, what do? You find the present value of the interest payable. And in this step, I said, you use the cumulative discount factor, the cumulative effective interest rate. Find the present value of the annual interest payable using the cumulative effective interest rate. What does it mean? Now, in accounting, in investment appraisal, if you are paying or receiving one amount that is constant over certain number of years, you use what we call cumulative interest factor, cumulative discount factor. So we're going to pay 120 for year 1, 120 for year 2, 120 for year 3. So we're going to be receiving 120, paying 120 each year from year 1 to 3. So what do? We go to the discount factor table and say, cumulative discount factor table, and say 9% year 3. And you find that the cumulative discount factor is 2.531. So when we come here, we just multiply only 120 that will be received in one of the years by the cumulative discount factor, and that gives us 303,720. Then the principal will be redeemed in the 3rd year. So you're not going to redeem the principal every year, so you cannot use the cumulative interest factor. You are only going to be using the simple discount factor. The discount factor table will show you what will happen if it is going to be redeemed in year 1, year 2, year 3, up to 20 years and up to 20%. So what you need to do is that as the years keep changing, you find you try to identify where you find it in the discount factor table. So we find the present value of the principal using the simple discount factor because it is only going to be redeemed in year one and the third year, and there's only a single amount. So at the present value of 2 million in the third year, which discount factor is 0.772 that you've been given in the question above, is 1.544. So the next step now to find the liability component of a compound financial instrument, you add the present value of the interest payable to the present value of the principal. So when you add 303,720 to 1.54, you are going to have 1,847,720. So the equity component is a balancing figure. In other words, you need to subtract. If you look at the step that I listed above, the last step is to subtract the present value of the principal and the interest payable from the gross proceeds to get the equity component. So by the time you take 1,847,720 from 2 million, which was a gross proceed, which is stated here, what do you have eventually? You have 152,280. So from the question that has been asked, they ask you to determine the liability component and the equity component of this compound financial instrument. So these are the steps. Go through the steps, follow them religiously, and you will be able to get it right every time. The only tricky bit in this question is always trying to identify the discount factor. And if you don't know how to use a discount factor table, just reach me in the comment section, and I will try to show you how to do it. So that is how to to separate compound financial instrument between the equity and the liability component. I hope this video you find it useful. Just click subscribe, and like the video, share it, and let other people benefit from what you have learned. In the second part of the video, we'll be looking at financial instrument at amortized cost, which is financial assets and financial liabilities, and the subsequent video will be looking at equity instruments. So come back and check on the next video. Thank you very much.